Realty Income does not seem to be recovering from the massive drop it's had year to date, down 23%. And in today's episode, we're going to explain why this stock is being suppressed. We're going to do our usual analysis. We will run through the income statement, looking at their top line, bottom line growth. We're going to look at the balance sheet, take a quick health check, total cash versus total debt. We will look at their competitors to see how they have performed total return over the last 5 years, as well as seeing whether institutions are buying or selling Realty Income. And we're going to focus a lot of time understanding why is this stock being suppressed, looking at the amount of debt they hold on their balance sheet, their fixed versus variable rate, as well as the percentage of that debt. And very importantly, we're going to see why are investors worried about the clients that Realty Income do hold. We can see Dollar General and Walgreens. We're going to specifically focus on them today. Nearly 8% of the rent that Realty Income receive are from these two clients. We're going to take a look specifically at these two and see if we have anything to worry about. Dollar General, as we can see, is down around 50% year to date, as well as Walgreens down 43%. And we will look and see whether or not there is something to worry about with those clients that make up nearly 8% of Realty Income's portfolio. Now, it is down 23% year to date. We can see it is at the 52-week low, offering a yield of 6.22%, which is very high for Realty Income. And we'll look as well at some very important financial metrics, dividend metrics, and understand how safe is the dividend. And you do really need to see these financial metrics that we will cover. There's a lot to go through in today's episode. And we will end looking at Realty Income, getting to their intrinsic value, finding the acceptable buy price and that margin of safety. So before we look at the historical performance, let's jump into the reasons why the stock has been beaten down so badly. And there's two main reasons. The first one is the amount of debt that they hold on their balance sheet. We can see straight away 19.5 million. Now, there are many reasons why investors are worried, but you just need to take a look at the debt summary, which is provided in their Q2 supplemental information to understand whether or not there is anything to be worried about. We can see 92% of the debt that they do hold is a fixed rate, and we can see 18 million of the 19 is fixed, 92% of which has a maturity of 5.9 years before they need to refinance that. They do hold that at 3.79% rate, with the current interest rate being higher than that. So the worry is that when they do come to refinance it in 5.9 years, it will be at a much higher rate. Now, what I would say personally, there isn't really a lot to worry about. In around 6 years, do we believe the rates will come down? In my personal opinion, I believe it will. And if it hasn't, I don't believe it will be as high as the rates we see now. On top of that, to gain a bit more comfort, we can see 84% of the total debt is in fact 6.7 years, so even longer than the weighted average of 6.9, and at a lower rate of 3.55%. So personally, I would say there isn't much to worry about unless you are of the person who believes that in the next 6 to 7 years, the rates will be much higher than they are now. Therefore, meaning Realty Income would need to refinance a lot of their debt, around 92%, at a much higher rate, essentially suppressing their AFFO per share. Now, this is one reason why investors are worried, and again, you can draw your own conclusions from what we've discussed. The other reason is a lot of investors see the diversified high-quality portfolio that Realty Income have as not very diversified. Now, when we take a look at that, we can see Dollar General, 3.8% of the annualized contract rent total for O. And we can see Walgreens, again, another one there at 3.8, making a total of 7.6%. Now, the reason why investors are worried, these two companies have had a horrid time in the market, and we will touch upon that now. Dollar General down 53% year to date. This has got investors very, very worried. And what we can do, given we have reviewed this recently on the channel, the latest essential stock valuation that we put for Dollar General, we got the intrinsic value at $145 with the current price at around $115. And what's on top of that, we're saying is if you were to buy Dollar General at $116, you would be getting a 20% margin of safety. and even Wall Street forecast Dollar General to move up significantly. So personally, with Dollar General, there are no issues from the analysis that we have done on the channel. So whilst we do see the share price having dropped 53% year to date, it does seem to be that just the sector in general is performing on a broad spectrum fairly poorly. Now, if we go back to the portfolio, we see the same case with Walgreens. That's essentially the joint top largest client within Realty Income's portfolio. They have also had a horrific time, down 43% year to date, and again at that 52-week low. Now, this is another one that we have recently reviewed on the channel. Now, with the share price around $21, we are believing the intrinsic value to be $31, significantly higher than the current price, along with Wall Street believing there to be some very strong upside to the current price at $21. So if you were to lock in a price around the current market value, you would be getting a 30% margin of safety based on the estimates that we run through. So again, there isn't really much to be worried about in my personal opinion with Walgreens, with Dollar General. These are ones that will bounce back once the macroeconomic conditions that we find ourselves in do start to have a better outlook. So that is another reason why investors are worried. Those two clients that we saw, 7.6%. And we can see there are others here which you could argue are facing some similar struggles, such as CVS. But a lot of them here don't seem to have any real worries in my personal opinion. We have Lowe's, Tesco, Tractor Supply. Again, it does depend on the investment thesis, but that is something just to highlight in terms of the two real reasons why the stock is being suppressed. One, client diversification may not be as diversified as investors believe. And the second one being that total debt that they have. Investors are starting to worry about the refinancing that will need to take place. But you do need to do a little bit of research yourself to see that realistically 84% of that has a maturity of 6.7 years. So that's that in terms of why it's suppressed. Now, more on the analysis of the company itself. Well, what are institutions doing? 78.82% of institutions are in fact holding Realty Income. And when we compare the inflows and outflows, we're around 2 billion worth of shares have been sold by institutions over the last 12 months. But institutions are buying a significant amount more than they are selling, around 5.82 billion. Now, I always say we don't base our buying or selling on what the institutions are doing, but it's good to have as an added layer of research. And when we compare over the last year and a bit, we see Q1, the green depicting the inflows, the red depicting the outflows. Institutions quarter on quarter are buying more than they are selling. And as we see in Q2, 1.6 billion bought, 250 million sold. So again, it's good to have as that additional level of review, but never base any of your investment decisions on institutions and do your own due diligence. Now, when we compare that to how the companies have performed, in essence, in the sector, we compare a few that you will have known: Simon Property Group, Kimco Realty, and a few others. So total return year to date, so this includes those dividends reinvested for Realty Income O, we see a total return year to date of 20%. Now, REITs as a whole have had a very tough time this year to date, and as you've seen, the macroeconomic conditions with the interest rates rising is a big worry, especially for those companies that have a large amount of debt on their balance sheet. Now, in terms of looking at the last 5 years, how does that compare for O when we compare it to their competitors that we have just discussed? Well, over the last 5 years, 9.9%, the third best out of their competitors. It's not something you really want in your investment over the long term. You want higher than 10% over the last 5 years. But as always, previous or historical performance is never indicative of the future. And again, just like the institution data, it is good as an additional layer of review. Now, moving on to the actual company and the balance sheet and the income statement, how they've performed, just to run through, they are down 23% year to date, with investors who have been holding the company over the last 10 years would have only seen a 19% increase. So the whole point is understanding, are we seeing a very cheap price for Realty Income currently, where we expect both the share price to double or triple over the next 5 to 10 years, as well as seeing our yield on cost in double digits, 11, 12, 13%. Now, jumping straight into the income statement and how they perform. Well, for REITs, we like 5 to 10% growth year on year. December 2018, 1.3 billion reported on the top line. Latest annual report, December 22, 3.3 billion. So nearly 3 times growth over the last 5 years. Very positive to see some very strong numbers. And on a more granular level, we do see those increases year on year, which again is very positive to see. And we'll shortly look at the last 10 years in percentage wise too. Now, bottom line, how does that compare? We can see in December 2018, 364 million reported on the bottom line. December 22, 870 million. So again, nearly 3 times growth on the bottom line over the last 5 years. But on a more granular level, we do see some inconsistencies. 2018 to 2019, we see a nice increase before then decreasing to 2021 and then picking up in 22. So bear in mind that bottom line is slightly inconsistent. Nonetheless, the income statement is looking good so far. Balance sheet, so a quick health check, total cash versus total debt. We see their latest quarterly report around 10 million of cash held in 2018, but their latest quarterly report around 254 million. So they're holding around 25 times as much cash as they did 5 years ago. So fairly positive, but how does that compare to the total debt numerically and directionally? Well, total debt 2018, 6.5 billion. That's quite a lot. And when we look at the growth, 20 billion. So that has increased by just over 3 times over the last 5 years. So that is a slight worry. So we will look at the net debt to EBITDA shortly and see how safe that dividend is. But again, this is also very typical with REITs that they do issue or have more debt so they can fund further projects. And one thing that we haven't really mentioned so far in this is that they are looking to diversify into the gaming industry with the deal they did with Bellagio. Now, moving on to the dividend metrics and dividend safety. Score of 80, making it safe, and a market cap of 35 billion, making it a large cap company. Now, for those that believe we're heading into a recession or a recession is looming, how did they perform? Well, last recession, they increased the dividend during the 07-09 period. Recession sales are relatively flat, bearing in mind this is above the average growth of companies in the S&P 500 during 07-09, which was negative to a larger degree. And we can see the recession return negative 43%. Now, this did beat the S&P 500's negative 55%, but it's not really a return you want from any investment. So a bit to digest for viewers there, whether you believe a recession is looming. Now, they are a dividend aristocrat. They have been paying increasing dividends over the last 25 years or more. So we can see 28 years of consecutive increases, 4% for the last full year, 3% over the last 5 years, and 5% over the last 20 years. Now, one thing I do say to viewers, and this is in particular important for the new viewers, you want to be aiming for a minimum of 4% increase year on year, whether that's your dividends, salary, or other income producing assets. The reason for this is the US inflation rate was 4% over the last 40 years. Anything less, you are in fact taking a pay cut and losing your purchasing power. So then we move on, and one thing to highlight is the dividend increases. Since the 1994 New York Stock Exchange listing, they have increased those dividends 122 times with 104 consecutive quarterly increases. And we can see here compounded average annual growth rate of 4.3%. So very good to see there if you are an investor. Now, in terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. 6.22 versus 4.35, we have our first sign of undervaluation. Bear in mind, we don't look at any model in isolation, and we'll draw a conclusion towards the end of the episode. Forward P to AFFO ratio 12 versus 18, another sign of undervaluation. And we can see the sector P to FO roughly in line with that of Realty Incomes of 12.2. Now, at the beginning of the episode, I did mention it is at the 52-week low, but always remember 52-week low does not signal undervaluation. 52-week high does not signal overvaluation. Now, typically, viewers know that we have the earnings payout versus free cash flow, and we tend to ignore earnings. It is susceptible to manipulation by management through accounting, and we focus on the free cash flow. However, for REITs, we don't tend to look at the free cash flow payout. It is more volatile than other companies. Reasons for this are such as upfront rent payments, maintenance expenses, which will skew the data slightly. So we focus for REITs on the adjusted FFO, funds from operation payout, and given they do pay the majority of their essential internally generated free cash flow as dividends, we are looking for around 90% or lower. So what we can see for Realty Income, for the large part over the last 10 years, it has been below 90%. The last few years, in fact, below 80%, 76% in 2022, and 2023 expected 76%. So very positive to see, and so far gives me faith in that all-important dividend safety score. Now then we move on to the adjusted FFO, funds from operations per share. Very positive to see, 241 in 2013, 392 in 2022, so it's moving in the right direction. Consistent increases year on year, very reliable, and we can see 2023 expected 407, so very positive in my opinion. Moving on to sales growth, we love it. 5 to 10% is what we want to see year on year for REITs, and we can see for the large part, Realty Income has done more than that year on year consistently. Very positive. And when we talk about this numerically speaking, 780 million top line in 2013, 3.34 billion top line 2022. Very positive, very strong growth. And if this continues, investors will be very, very happy. Now, not everything is rosy with Realty Income. One of the red flag indicators or issues that I personally have is the fact that they continue to increase their shares at a very, very fast rate. Viewers who have seen REITs analysed on this channel will understand this is probably the highest increase year on year than any of the other REITs. 192 million worth of shares outstanding in 2013, 612 million in 2022. So what this effectively doing is diluting your position as a shareholder, issuing shares year on year. Now, the reason why they do this, obviously they do want or are looking after the shareholder, but the reason why they do this is they are looking to fund property acquisitions. Given, as mentioned earlier, they do retain little of that internally generated cash flow as they pay that out in dividends. So one sort of red flag indicator or something to be aware of if you are an investor or a potential investor. Now, return on invested capital, ROIC, it is one of my 7 golden dividend metrics. Do check the pinned YouTube video if you want to see the other 6. What I like to see for typical companies, 10%. It means management are able to effectively allocate their capital. For REITs, it's more typical to be 3 to 5%. So what we see consistently from 2013 to 2020 isn't bad at 4%. It did drop to 2% in 21 and 3% in 2022. But hopefully if they can bring it back up to 4% consistently, then that will be okay in my opinion. Operating margin looking very positive, consistently in the high 40s. We do see it slip in 2022, but if it goes back up into the 40s, this is very positive. As always, the higher the operating margin, the higher that expected bottom line net income will be, which in turn will mean more dividends paid out and a larger dividend increase year on year. Finally, the biggest worry or the biggest red flag indicator from the balance sheet review is that increasing total debt. Yes, it is expected from REITs, but one thing to be aware of, we look for a maximum of 5.5, which signals the number of years it will take the company to pay off all of their debt net of cash on hand. And as we can see, for the large part, it has been around that, even higher on some occasions, as we see in 2021. 2022 at 6.21. Now, the positive sign here is that it is expected to drop to 5.15 in 2023. But if it does continue to go higher, it will in effect that dividend safety score. But so far, I can be comfortable with this. On the right, we see the net debt to capital, the percentage of a company's financing from debt as opposed to equity. Now we jump into the stock valuation for Realty Income. As always, if you do enjoy the content, value is being provided. Do smash that like button, do hit the subscribe and bell button if you want to be continually notified of these regular videos as they drop. And as always, if you want to grab a copy of the valuation model to run to your own companies in your portfolio to get your own intrinsic value and acceptable buy price, do click on the pinned comment below. Now, starting off with Graham's valuation, which is the first of the 4 models. Typically, this is what we use when we analyze companies. However, for REITs, it is not applicable, so we will be excluding this from the intrinsic calculation. But for those that are new and want to know how it works, we put the stock ticker in here, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. This gives an intrinsic value of $32. As mentioned, that's how it would work for normal companies that aren't REITs. So the first model we're looking at is the REITs multiples valuation model, companies in a similar sector and size that we analysed as in comparing the 5-year total return. Federal Realty, Simon Property, and Kimco Realty. We have their stock price, P to AFFO multiple, the average, multiplied by that of the P to AFFO divided by the price to get a stock price on the REIT multiples valuation of $54.66. Now, when we take a look at that, that is above the current price, around 10 to 15% upside, but within that 52-week range, showing signs of undervaluation in the current market. Bear in mind, we never look at any of these models in isolation and will draw our conclusions towards the end of the episode. We then move on to the second model, the dividend discount model. Now we see those consistent increases year on year around 3%. We are still waiting for a final increase in 2023, so I would expect this to go up to around 3.25 to 3.5. So with that in mind, I have gone for what I believe to be the average over the last few years. Though if you do believe it to be higher, or you think that based on your own investment thesis it should be lower, if you grab a copy of the model in the pinned comment below, you can play around with the percentages as well. So based on my estimates and judgments, it gives a DDM price of $67. Now, when we take a look at that, it is right there at the 52-week high, well above the current trading price, showing signs of severe undervaluation in the current market. We then move on to the third and final model that we use, the DCF model, where we have our free cash flows year on year. Average growth rate around 22%, with analysts estimating between 6 to 7 forward looking. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, and arrive at the equity value. Divide that by the shares outstanding gives a DCF price of $64. Again, slightly lower than the 52-week high, above the current trading price, though, showing again signs of some severe undervaluation in the current market. And do note that we did see rough highs of the stock over the last few years at just shy of $80 in 2020. We then move on to the intrinsic value calculator, which is the average of the three models that we have just run through. And if you do enjoy the content, value is being provided, smash that like button. It really helps the channel and the community grow. And do click that bell button and subscribe if you enjoy these videos and want them to be delivered to your doorstep. So the intrinsic value we've got today is $61.86. Now, with the current price at $49.35, margin of safety I would use would be 10% if I was to believe it had a wide moat, strong financial metrics, good forward-looking data. So your acceptable buy price would be $55.68. For those that believe a margin of safety of 15%, you'd have a buy up to $52. 20% a buy up to $49, which is roughly the current price now. Now, personally, for Realty Income, I'm happy to buy it at a 20% margin of safety and have been adding shares at the current price around $50. However, as always, do let me know your thoughts in the comments below. Are you looking to add Realty Income, looking to sell, or purely on the sidelines speculating? Now, Wall Street sees some strong upside to the current trading price, just at shy or just $1, in fact, over our intrinsic value at $62.80. So they also see some severe undervaluation in the current market. As always, if you want to grab a copy of the valuation model, then do click on the pinned comment below. Grab a copy. You can run your own companies in your portfolio to get your own acceptable buy price and intrinsic value, or even if you just want to run through Realty Income again. And if you do want to join us in the Discord, where we're talking about the buys and sells of last week, as well as looking ahead to next week, anything to do with the stock market and finance related, do click on the Patreon link below. As always, do drop your thoughts in the comments below. Do like and subscribe if you haven't already. And as always, catch you on the next episode and take care.